Hello and welcome back to the Research Analyst series of NISM. So we were covering the different topics in the Research Analyst series. So let's start the next topic. Next term we have is REITs or InvITs. So Real Estate Investment Trust and Infrastructure Investment Trust are investment vehicles that pool money from various investors and invest in revenue generating real estate projects and infrastructure projects respectively. As the name indicates, these vehicles are formed as a trust. They issue units to the investors to raise money. They enjoy favorable tax treatment as long as they meet the necessary regulatory requirements. Regulations stipulate the minimum amount of assets that have to be held in the form of revenue generating assets. In the case of REITs, that is 80% of the asset should be held in the form of real estate asset. Similarly, for InvITs, a regulation stipulates that 90% of the unit capital should be invested in revenue generating infrastructure projects. These assets can be held directly or through a special purpose vehicle, that is SPV. In the case of both REITs and InvITs, the trust has to distribute at least 90% of the distributable surplus cash flow to the unit holders. Next term we have is commodities. So commodities are basic materials or goods that are largely homogeneous in nature. These goods are interchangeable with other goods of the same type. Thus, a bar of gold is commodity while a jewelry made of the gold is not a commodity. This is because an investor would be indifferent to different bars as bars of gold as long as their quantity and quality remain the same. However, in case of jewels, the buyer may prefer one design over another even though their weight and quality may be the same. Commodities may be hard or soft. Hard commodities are essentially natural resources that are mined or extracted. This includes all types of metals and crude oil. Soft commodities, on the other hand, refer to commodities that are grown. That is, agricultural products. Soft commodities includes grains and pulses. Commodities are largely traded goods that are meant for use in production of goods or for consumption. Since inflation and prices of commodities are directly related, investing in commodity can help protect real value of investment. However, most of the commodities involve huge storage cost and are thus not suitable investments. Having said that, there are certain avenues available to invest in commodities. Next term we have is precious metals. Precious metals Precious metals such as gold and silver are viewed as an investment that can help preserve a real value of money. Unlike many other commodities that have short life, these precious metals have very long life. Further, storage cost on these metals is very small compared to their values. These characteristics make precious metal a viable investment option. Next term we have is commodity ETFs. Commodity ETF is an exchange traded fund that invests the pooled investment in a range of physical commodities. Investors can invest in commodity ETF by buying the unit of the fund. The value of units largely moves in line with the net asset value of the fund, which in turn moves in line with the commodity prices. Since the storage is handled by the fund, the investors do not have any storage obligation. Although commodity ETFs can be created for any set of commodities, gold ETFs are the most common commodity ETF products as they are easy to store and manage for the fund. Next term is managed futures contract. So futures contract is a contract to buy or sell an asset at specified future date at a specific price. Since the price of the contract is predetermined, the buyer of the contract lends to gain if the price of the product increases in future. The reverse is also true. An investor can gain out of price rise without buying the product. Managed futures contract refers to a portfolio of futures contract that are actively managed by professionals. Instead of buying the actual underlying asset, the investment managers take position in the futures contract. Investors can thus invest in commodities through managed commodity futures contract. Next term we have is warehouse receipts. So warehouse receipt is a document that shows proof of ownership of goods that are stored in a warehouse. Most of these warehouse receipts are negotiable. Thus, the title to the underlying goods can be transferred by simply transferring the receipts. Next topic is structure of securities market. The market in which securities are issued, purchased by investors, and subsequently transferred among investors is called the securities market. The securities market has two interdependent and inseparable segments. First one is primary market and second one is secondary market. So the primary market, also called the new issue market, is where issuers raise capital by issuing securities to investors. Fresh securities are issued in this market. The secondary market facilitates trades in already issued securities, thereby enabling investors to exit from an investment or new investors to buy the already existing securities. The primary market facilitates creation of financial assets, and the secondary market facilitates their marketability, tradability, which makes these two segments of financial markets interdependent and inseparable. We shall look at each other of the markets in detail in the next section. So the next topic we have is ways to issue securities and the primary market. So we will cover this topic in the next video. That's it for now. Thank you.